This is Smart Investing with Mike Rand.
The more you owe, the more interest you accrue each month.
Certainly not accruing any interest in this conversation.
Securities and advisory service offered through KMS Financial Services.
This is Smart Investing with Michael J. Rand.
I don't know, the word self-absorbed comes to mind.
And pretentious. Definitely pretentious.
And he's got a big ego.
Okay, we seem to have a theme going here.
With Michael's producer, Chris Martin.
Last night I ordered a pizza by myself and I ate it over the sink like a rat.
This show is live.
And call-ins are welcome.
Or you can email us your questions. Go to smartinvestingshow.com to see how.
For I have the pride, the privilege, nay, the pleasure of introducing to you the one, the only.
This is Smart Investing with Mike Rand.
Well, hello, everybody. You are back with Smart Investing. I'm Mike Wren, your host. This is the show about investing where we try to take that topic and make it easier to understand, to get you good and relevant information on each and every show, and be entertaining. Anything happening in the entertainment world, Chris, as we sit and speak?
Sit and speak. I
says the person who thinks that they're, he immediately says to me, that thing in Russia and that big asteroid, I'm very, very uncomfortable with.
I'm just
this
saying, and maybe it's the Art Bell in me, but I'm just saying, two large bodies finding the Earth at the same time just seems like a very, very large coincidence. And let me tell you why I'm thinking
Hold
this.
on, let me reassure you. Let me reassure you in the proper way and then the proper dialogue.
All right, here we go. Verbal spanking.
Ja znаю очень хорошо, comrade. There you go.
It's like
that's for our zero Russian audience.
Yes, for streaming in Russia that no one listens to because they all still have dial-up.
Ja znаю 10 slov по-русски.
Did they get out of dial-up yet?
Yeah.
This is what I'm saying. Do you remember the movie Armageddon?
Mm-hmm.
Okay.
It has one of the best soundtracks ever.
They never mention the asteroid until it completely takes out like Japan and Paris. And then they go, oh, well, everybody knows about it now. So suddenly we have this asteroid that comes out, takes out a little bit of Russia. Oh, everybody knows.
It didn't take anything out.
It took out some windows.
Yeah, and
it's just less special effects. That's all.
The shock took out, the ceiling, the roof of an old warehouse.
I'm just saying. Just seems like a large coincidence.
Chelyabinsk, I think, is where it was at.
And I'd start to get a hold of Bruce Willis and some drillers, but unfortunately, I've heard Last Die Hard's not very good, so maybe Bruce isn't our guy anymore.
But there you have another coincidence, because The Last Die Hard is filmed where?
In Russia.
You've connected the dots. Oh, my God.
Maybe it's the galaxy's way of trying to get rid of Bruce Willis. He is a national treasure, and the universe hates him.
Did you see Loopers? It was kind of a strange thing with him in it.
Yeah, it was a little odd.
Yeah. I had some strange dreams after that. It just didn't sit well with me. And I don't know if it was because
of killing your younger self.
No, I just don't know if there was because the movie was so poor or if because it's like, that is so dark and odd.
It was one of those things where you see the trailer and you're like, that looks great, and then you watch it and you're like, what movie did I just see? It was not what I intended.
I'd like my money back.
Yeah.
So anyway, let's talk about investing, shall we? Maybe a little bit? Yeah.
Sure. We got an hour.
Okay. First off, let me give you the telephone number, because if you've got a situation, if you need reassured for a particular reason, I think you should call 509-241-5900. Okay? 509-241-5900. Call, tell me what's bothering you, and we'll try to make it so it doesn't bother you so much. You kind of know what bothers me. Too many packaged products, okay? We are dealing with an environment right now that is very, very unique, and most people, especially my industry, don't realize it. The corporations and companies realize it. By the way, we've got Michael Dell. The stock of Dell Computer is so low that he's basically trying to steal it from the shareholders, which means all of the shares outstanding times the price. That's what the company's worth. He's trying to take some money plus some money from Microsoft and a money from another venture capital firm, I think it is, and buy the company for its entire price right now. Why would he want to do that? Why would somebody that likes making money try to buy all of their own company back at the share price that it's currently at? Logically, that person that likes to make money obviously thinks that that company is a pretty good deal at that price. And he's even gone out in the public and said, oh, well, I know that maybe 9 months ago I said that we were going to deliver this many personal computers, but I'm lowering my expectations and we might only sell this many computers. And by the way, I'd like to buy the whole company. That's like somebody trying to trade you property at Monopoly, where I'll give you these two, I'll give you Baltic and Mediterranean, I'll give you all the blues if you just fork me over Boardwalk.
Sounds like an old owner I used to work for. We had a warehouse, and let's say we made $50,000. Well, it wasn't doing a whole lot of business, so they had to shrink the warehouse to like half. Mm-hmm. But he goes, look at the bright side, we only have to sell $25,000 now. That's wait, what? Paul is on the phone and he has a question for you.
Thank goodness we've been saved again by a caller. Paul, thanks for calling the show.
You bet.
What's going on?
Well, my question was, I was listening to Dave Ramsey, and he maintains that in this day and age that you can make 10 to 12% interest, and I fail to. When I go to the bank or the credit union, the best I can get is like 1.29 or something.
Well, that's because he used the wrong word. Interest is not the correct word when you're talking investing in companies, because there is some, if you invest in a company or a mutual fund for that matter that pays a dividend, some of your gain is dividend income or yield or interest, in other words, and the other part is capital gain. Another way to think about this, Paul, is just think if you owned a rental property, okay? If you owned a rental property and the rent that you were charging on the property, let's say, netted you $100 a month, okay? So after you got your payment from the renter and paid the mortgage and insurance and all that, it was $100 more than you needed, so you got to put $100 in your pocket, okay? Okay, so that's $1,200 in a year. So do you make anything else from that rental property over time?
Well, you'd make your capital investment credits.
What you mean the house had just become worth more money over time?
Right.
Yeah, exactly. Perfect. So you're following along. So Dave Ramsey's being pretty ballsy saying 10, 12%. I mean, that's what people have earned last year on several index-type investments in the stock market and so on. But he used the wrong word, interest, just because his show stops where my show kind of starts. His show is perfect because he tells people to pay off their debt and so on, but his show ends where mine begins. So he just was using the wrong term, interest, and he should have said something like, folks on their investments, for example, that have invested in, let's say, a S&P 500 index fund last year might have earned on their money 11, 12, or 13%. Don't forget that's an investment that's volatile and goes up and down. The less than 1% that the bank is giving you, at least you're getting that minimal amount without any risk.
Okay. Well, then my next question would be, what's the best thing to invest money in right now?
I don't know. I don't know you, Paul. After we talk, I may say, leave your money in the bank. After we talk, I may say, wow, you seem pretty reasonable. Like, I think that you could own some companies going forward. I just don't know. I mean, in general, if somebody says, yes, I'm an investor and I've invested for years before, what I was going to talk about before you called, but I was just going to reiterate to people how profitable the ratios are for people owning individual companies, where just the dividend that you get by owning several different companies, just the amount of profits that they share with you per year, is equal to or greater than the interest that you get on a 30-year treasury, which would be 3%. And, of course, 3% is better than any CD you can find. And 3% actually is better than 60, 70% of the interest returns that you get from any fixed income bond fund investments out there. So that's pretty significant. In fact, it's extraordinarily significant that the dividend that you get directly from several companies is at 3% or higher. When you add to the fact of that these companies typically will raise their dividends, if not every year, at least 6 or 7 out of every 10 years, and you also add to the fact that you own the company, so that company increases in value over time if it's a well-run company, it's absolute paradise, truly. And usually when we invest in companies, the dividend yield is only about 1.5%, not 3%. Why is that? Because the prices of these companies compared to the rate of their dividend is usually a lot higher. And I've been doing this for 22 years, so I'm used to telling people, listen, I know that your dividend rate is only 1.5% or 2% now. 6, 7, 8 years into the future, your dividend from this company will finally exceed what you could get from the bank CD or from a government bond, for example. But in this day and age, it's absolute paradise for an investor like me because right out of the chute, day one, I can equal or beat the interest rate just with the dividend. That means that any sort of gain that we get from the capital gain side is just gravy. And it also means that a reasonable person is going to be willing to take a little bit of volatility because they know that they're getting a darn good dividend right up front.
Yes.
Pretty amazing to me. And my industry is not focusing on that. My industry is telling everybody to own a mutual fund in every different asset class and have fun.
Okay, I had one more question for you, if I may.
Chris, do we want to take it or make him go into the cooler and we come back from the break? Which would you like?
You can answer it quick or make him wait.
It can be very quick.
Okay, right. Go for it, Paul.
Let's do it.
How come when I was in school they never taught us what the rule of 72 was?
Because if I was even if I went to a business school like Wharton or MIT, I could take a flamethrower to the place because they just do, I think it's a technical term. Are you ready for it? They do a piss poor job of educating people.
I agree.
Well, I'm glad I made you laugh. We better take a break.
Thank you.
You bet, Paul. Have a good one.
You too. Bye-bye.
Bye-bye. So anyway, I'm Mike Wren. It's the show Smart Investing. You're listening live on 590 KQNT AM, and gosh, I'd like another telephone call if you want. 509-241-5900. Chris will be the one answering the phone, so make sure you're nice to him, and we'll be right back.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances, and if necessary, seek professional advice.
This is Smart Investing with Michael J. Wren and Michael's co-host, Chris Martin.
Can they deliver? They're both great.
Hello, everybody. We're back with Smart Investing. I'm Mike Wren, your host. Telephone number here to the studio is 509-241-5900. You can find us on the web at smartinvestingshow.com. Well, my coffee-drinking little producer, how are you doing now? Are you still jittering like the gerbil?
Wrong pipe. I know there's no such thing as wrong pipe. But...
No, I mean you said that you had
jittery.
You had two.
I'm fine.
He's looking at me right now. It's like Mike.
It's like you jump into the studio and a couple of programs aren't what they should be, and then I've got you showing up so very early for the show.
But you were looking at me just exactly now. It's like, Mike, leave me alone.
I'm over it now. Don't remind me of all the things that happened in the previous hour, because now I'm gonna. Yeah. What are you, my wife? You got to keep bringing up the past.
So anyway, as Chris does his job, and manning the phones is a big part of his job. Yeah. Investments today, you the listener, they're amazing. Do you notice how I don't back off the position about investing in good companies and taking the dividend and taking the capital gains and taking the volatility? Do you notice that I don't retreat from the position and say, and if you don't like that, you should consider a really, really safe blah, blah, blah XYZ mutual fund, or you should consider a blah, blah, blah really safe like annuity? Okay. Do you notice how I don't do that? It's because you are still, unless it's a fixed annuity, you are still going to take volatility with its sub-accounts, okay? And if you don't understand sub-account, then obviously don't get an annuity. And if you're going to take a less volatile mutual fund, it's still going to be volatile compared to the bank. So do you see how that makes me very, very different? It's like, this is investing, or we're either going to go for a drive or we're not going to go for a drive. And that's it. So anyway, we've got a caller on the line. Thanks for calling the show. Go ahead with your question.
Hi, am I on?
Yeah, you are on. Is this Jack or Jeff? I can't read Chris's writing.
It's Jack.
Okay, thanks for calling. What's going on?
Absolutely. So my question kind of goes back to when you were talking about Dell Computers and buying back their stock and everything.
Oh, yeah, where he wants to basically steal, in my opinion, he wants to steal the company from the shareholders.
And that relates to the fact that PE ratios are really low these days. Is that kind of what you meant?
PE ratio, some of them are low, a lot of them are reasonable. Okay, the PE ratio, it's important to me, but it's just one of the important things. You know, it'd be like, well, we could talk about, we can't just solely talk about a price-earnings ratio or a price-to-book ratio or price-to-sales or earnings growth rate or something like that, but they are important. What I can tell you is that some price-earnings ratios for like cyclical companies, I think happen to be low. A lot of price-earnings ratios for the good bellwether companies that people are really comfortable with, like McDonald's and Coca-Cola and so on, those happen to, I think, be very reasonable, not high-priced. And a good way to think about a price-earnings ratio is an average temperature. You have to compare it industry to industry. I know a lot of people say, well, the PE ratio for the S&P market, to me, that's completely meaningless. You want to make sure that you are a little bit more targeted so you get a little bit more value out of that number. And so I typically will compare, telecommunications together, defense companies together, obviously drug and biotech companies. And you've got to give a biotech company a little bit different of a valuation than a big drug company because usually the biotech won't be paying you a dividend and so on. But, yeah, it gives you a relative warmth. A PE ratio, if you took the average temperature of the West Coast and you had it at a number, let's say 70, then you would know just at quick glance that this particular city was hotter or colder than that average number. That's how I use price-earnings ratios, unless they're extremely high, which means something is screwy, that their earnings have dropped off the face of the cliff for some reason, or their price has shot up, or their price-earnings ratio is really, really low, and then I wonder what's going on there too. How come the price has stayed so low and their earnings have shot up? So unless they go really, really high or really, really low, which says I should do more investigation, I usually use them just as a relative warmth type of an index. Does that make sense to you?
That makes sense.
Okay.
Going forward in the next 10 or 20 years, as more and more baby boomers retire, do you expect to see more situations like that with Dell as a lot of people cash out their 401ks?
Well, I don't understand. I don't know. It doesn't. But it doesn't mean you asked it in a wrong way. It just means I don't understand.
Well, would we see like money flooding away from the market as a lot of people go towards more to being on fixed incomes?
No, not at all. Because they don't forget the baby boomers inherited from their parents too. They have all the money, so they have enough money that this mass liquidation to live on things really isn't happening. It just means that they're not great demanders of money where they don't need a lot of credit. But, yeah, a lot of this, the demographics are changing. More, I would, instead of thinking, what are they going to do with their investment dollars, think of the back door. What are they going to do with their dollars each and every month? Well, they're obviously going to buy health care and things like that. Do you know what I'm saying?
Yeah.
Yeah. I think more of specific things that I can actually think about rather than try to take a big demographic and and just categorically state that they're going to do something with their investments, because we don't know. Good enough?
Excellent.
Okay, is that good enough, Jack?
Absolutely. Thank you very much.
Okay, take care.
You too. Bye.
So, Chris, are we going to take a break or take a call? Draw the straw.
Yeah, we got to take a break. It's the bottom of the hour.
Okay, let's take a break. And
hang on, Robbie.
Yeah, we've got 1 or 2 callers on the line. Just one? Okay, Robbie, you hold the line. We'll take a quick break. If we can make her quicker, we'll come back and hold the line. I'll take you straight away. This is Smart Investing. I'm Mike Wren, your host, and we'll be right back.
This is Smart Investing with Michael J. Wren.
The U.S. dollar is in terrible shape. It's moved down against the yen. It's moved down against the euro. And last week, it moved down to its mom's basement.
Hello, everybody. We're back with Smart Investing. I'm Mike Wren, your host. We have had a very, very nice caller hold on through the break. His name is Robbie. He's on line 2. So, Robbie, thanks for calling the show, and thank you very much for being patient.
Hey, no problem. You won't think I'm so nice after this. You know, I look forward to your show every week, and then I listen today, and I wonder why the hell I look forward to it the whole time.
I have that same feeling.
Yeah. So what's up?
I love your show. It's literally, I do look forward to it every week. I like you and Chris's banter. It makes it friendly, and it makes investing and stuff seem a lot less intimidating, and puts it on kind of a local, easygoing level. And I really appreciate that from you guys.
Well, that's nice. Thanks for saying so.
Yeah, you know, my question is, I'm in the military, and we were given an option. I don't understand what it is, but are you familiar with the TSP or the Thrift Savings Plan?
I'm familiar with it a bit. Depends on what you want me. It just depends on the question.
Well, it's so complicated. You know, they don't match because we're not members of Congress. If I was a member of Congress, they would match up to 5%. Of my base pay.
And you'd work significantly less.
Yeah, I know, and I wouldn't even have to do anything except for screw the country over it.
You're right.
You know, and yeah, I guess Congress is less popular than gonorrhea. So
than me.
Sure.
Yeah, they're less popular than the financial industry. That's saying something.
That's amazing. I mean, they're a bunch of idiots. But but they give themselves a matching plan. I think it's called FERS or something like that with the federal employee matching program. But I don't get that. But I am able to put 5% of my pay towards this TSP, and I guess it's in government. There's several different options.
I think you have 5 or 6, or 4 or 5.
The main one they want us to do is the L program, I believe, and it's like government bonds or something.
Okay. Well, obviously you don't do what they want you to do. That's just me. If they want me to do something, I want to do the opposite.
Right.
And that's just my personality.
So,
potato, So, don't do the bond fund.
Don't. Okay.
Absolutely not. Because you sound young, too, so it's not going to benefit you. You know, it might benefit you for the odd 6 or 7 years, like these last 6 or 7 years where bonds did better than the market, but that doesn't happen so often.
Okay. So go into one of the G or the H or whatever funds that are tied to the market.
Yeah. Explain them to me. Do you have it in front of you?
I don't, and even if I did, it was such a bunch of government crap that made it look like
okay. Well,
it was horrible trying to even understand it, but I know I need to do something. So.
Yeah. Well, here, let me give you a little bit of advice. Is that if there's something tied to anything called the S&P 500 index, or maybe I think that's what they're going to use.
They do. I know that they have one that's that.
Okay, that's not the worst thing for you. Okay, because what's nice about that is that the index is going to, one of the things that I don't like about the index is that it owns a lot of Apple. Okay? The index is an unmanaged list of companies, and that you own them regardless of what's happening. And so when Apple was shooting the lights out, it obviously meant that when you own the index fund, one of the risks to the index is that you own Apple at a very, very high price. Now that Apple has come down 20%, one of the big negatives that I like to throw at in index funds really isn't there right now. What's nice about an index fund, too, is it has low expenses because nobody's managing it. It's just a computer model. And it's also nice because nobody can screw it up. There isn't a professional manager that can do something really, really wrong.
Well, but If it's the government managing our fund, they don't do anything.
No, it's not. That's a one.
Okay.
Yeah, I can guarantee you it's not. It's just an index, so you're okay. The only thing that you will get that some people will tell you it's bad is the index will be as volatile as Dan Rather quotes the Dow Jones on the news every night. I know he's retired, but whoever the news person is.
Right.
Okay, that's a good thing because you're buying every single month. So volatility can't hurt you. It can only help you. Truly. Because the prices are good.
If it goes down and crashes, I'm still putting my 5%. I don't even notice it.
Right, and you just bought more. You just bought more because the price was up, and if the price goes up, you're going to buy less.
Right, that makes sense.
Okay, cool. Now the other thing,
want it to be down.
Yeah, exactly. Then the other thing I'd like to suggest is that if they offer you some sort of an international index, you should put 20 or 30% into that. And then have the rest in the one that's in the S&P. And the reason is because 2 years ago, everybody thought, oh, Europe's wonderful. Now this year, oh, Europe sucks. It's horrible.
Right.
You're in the military. You've probably been there, right?
Yeah, several times.
Okay, and you know that there's really no entrepreneurial spirit over there, and they just kind of get paid for attendance. So Europe is never really as good as everybody says it is, but it's also never really as bad as they say it is. And there's some really good companies on the European continent that are trading at lower than average prices just because people have bad attitudes towards them. So you're getting a little bit good deal over there.
Okay, in specific countries, I look at like Russia, and I think they're just the best because not the best as far as monetarily or anything, but their entrepreneurial spirit, from what I've seen.
You're right.
Not only there. I mean, because I've been there and just seen these people are amazing and I love them. But also, in America, and they come here and man, these people are natural entrepreneurs. They're starting businesses. They're doing everything they can.
Well,
not only to barely support themselves. But
any immigrant here.
They're amazing. I love these people.
Yeah, any immigrant coming here.
Right.
That's the reason they come here. That's what's
right.
nice.
So
but yeah, I would agree with you. Russia has enough hooliganism and entrepreneurism that it's awesome, but their economy is completely fake, so you can't go there.
Okay.
Yeah, I believe me. I go there several times in a year, and you cannot deal with that economy. It's completely. You just can't. The whole world shuns them because it can't be trusted. Kind of. So you've unfortunately, like the Netherlands and stuff like that, you can find good deals and just stay away from Russia for exactly now.
That's really too bad because they are such great people.
Oh, I agree.
That's awesome. So, all right. Well, all right. I'm going to look more into it, and if they have one that I can split between foreign and domestic, which I'm sure they do, they have a bunch of them. Then I will. You can
always call me at my office too.
Okay, all right. I really appreciate it, Mike. Your show is great. I do like it.
Well, thank you. Do svidaniya.
All right, do svidaniya.
Okay, bye. So, do we need to take a break, or I think it's a long segment. I don't need to take a break exactly yet. Well, we need
5 minutes to rant.
Why don't we have another caller? They should be stacking up. I mean, we're having fun. So, telephone number is 509-241-5900. So when you're looking out a windshield of investing, everything that happened last month, last year, the last 10 years, don't think about it. Truly. Just think about going forward. When you're thinking about investing, a lot of these package products / annuities that people want to sell you, they have what I like to call golden handcuffs to them. Okay? Which means that if you take your money out of this thing that you're being sold for the first 4, 5, 6, 7 years, they're going to charge you a penalty to get out of it. Okay? It's called a surrender fee or a surrender charge. So you are putting your money into a package product like that with the thought that your money's going to stay there for that long. Okay? If you're going to leave your money in a spot that long, I think that you have to be the village idiot not to just own companies for that long. I could see owning some sort of a package product for a short amount of time because you had a need for that money, let's say within 5 years. and you really didn't want to take the greatest amount of volatility with your money, and you did want some guarantees set forth to you, because in 5 years, you're going to have to access a major portion of that money to do something with. But truly, when you're thinking about owning something for 7, 8, 9 years, if you're listening to the show, you've got enough education behind you. You know intuitively that the longer that you hold the investment, the better off you are. The less likely that you'll lose money, and the less likely that volatility is going to scare you over that time. It's going to mediate over that time. So if you're going to own something for 7, 8, 9 years, why not own something good? Don't own crap. Just ask them that. Well, it's why if I'm going to, of course, if they want your money that long so they can charge you a higher expense ratio for that many years. They're not having you own it to make sure that you're going to make money. They want you to own that product for that many years, so they've got their actuaries figured out, so they for sure are getting from you a certain percent of interest on your money for them over that period of time. And if you take money out prior to that time, they charge you extra, so they come out. So let's see, the agent makes money, and the company makes money, and the client makes, see what I'm saying? So if you're going to look at some of these annuities that want your money there for such a long time, my God, don't give anybody. Give yourself the money and just own a block of really good companies for that same amount of time, and you'll make money like crazy. Now, the insurance person is going to say, well, what happened if the market goes down? And I'd say, well, what happened if you get hit by an asteroid? It's not fun, is it? Okay? Getting hit by an asteroid. Too soon. Getting hit by an asteroid probably isn't fun, and it would probably kill you. The market going down isn't fun, but it doesn't kill you. So you don't have to. They are telling you that you should be more afraid of the volatility than you should be. You already lived through one of the worst markets in history. And most of us, or all of us alive, won't encounter a market like this again, because, to use another term from astronomy and space, it's kind of like Halley's Comet. It's regular, but only about 70, 80 years.
Yeah.
Okay?
Like my grandpa.
So don't be too afraid of what's happened. Look at it in a very, very realistic point of view. You lived through it. You're still alive. Your money lived through it. And if you didn't panic out, you were back to even, and now you're gaining. So what are they protecting you from? They're protecting you from you panicking. If you won't panic, you don't need that stuff. I'm Mike Wren. It's the show Smart Investing. You're listening live at 590 KQNT AM. Telephone number here to the studio for those of you that wish to call. It's the last segment. I think you should call. 509-241-5900. We'll be right back.
This is Smart Investing with Michael J. Wren and Michael's co-host, Chris Martin.
So I'm assuming there's a point to this.
Oh, I sure hope so. I'm on the edge of my seat.
Hello, everybody. We're back with Smart Investing. I'm Mike Wren, your host. I started this second segment with the term annuity rescue or bad investment rescue. And the reason I use that term is if you are in ownership of an investment that you don't like, now is a good time to get out of that investment and reset everything, because there are a lot of good and reasonable deals out there where the average price for companies that you can really identify with and like and love, they're not the greatest deal in the world, because we're not dealing with the year 2008. Prices aren't extraordinarily low. Wouldn't that be awesome now, you knowing what you know now? Just think how differently you'd behave if you knew the world wasn't going to end, and I could rewind back the clock to 2008 when everything crushed. You'd be buying stuff like it was going out of style. And I think there was some guy on the radio show telling you that the world wasn't going to end. Wasn't there somebody, Chris?
I don't remember.
I think people were actually berating us, saying, yes, the world is too going to end, darn you guys.
I believe one of the things was, you guys are too positive. You're too optimistic about the future. Okay.
You can't talk like
Thanks,
that while I'm
Dad.
taking a drink.
And then I had to thank my family and tell them to stop listening to the show.
So anyway, yeah, just think of if you knew then what you know now, how much money that you could make. And I'm telling you, now is not all that different from then. It's been a decade since the market's done anything. And the general market, in some degree, affects the prices of the individual companies that I like and I know that you would like too. So the prices are reasonable. So if you're going to be pitched a product that you have to own 6, 7, 8 years, or else you're penalized to get out of it, that penalty right there takes away some of the fun. A lot of those annuities, too, they try to counteract this by saying, but if you leave your money there, you get something called a living benefit that will compound at 5% per year, 4% per year. It's not walk-away money. It's money that kind of ultimately can be yours if you surrender and leave your money forever with the insurance company, annuitize it, and just take a payment for the rest of your life. Boy, that sounds fun. So everybody fixates on the 4 and 5%, the person selling it and the person buying it. Okay, well, why don't you start out at maybe 3.5%, but your dividend goes up every year? And there isn't a surrender penalty. That sounds pretty good. Let's see. Furthermore, the one thing you're being sold, it's an insurance person or an insurance person disguised as an investment person, and you're buying some insurance product annuity from an insurance company that you have heard of or you have not heard of. Well, let's say you were thinking of maybe, and this is not a solicitation to buy or sell, but let's try to pick the names of companies that you know like the back of your hand. Ever heard of Johnson & Johnson's baby shampoo? Okay, there's a company out there called Johnson & Johnson. Its dividend is 3.2%. I know that they've paid a continuous dividend beyond 70 years. That's pretty good. Okay, longer than most people have been alive or that are listening to this show. What? What are you laughing at?
Nothing. It seemed rather harsh.
DuPont or Dow Chemical, 3.6 and 3.9%. I think people are still going to need chemicals to do stuff.
Always.
Yeah. Okay. Let's go really, really simple. Let's go Coca-Cola. Coca-Cola. I don't see Coca-Cola just drying up and blowing away in the wind anytime soon. By the way, they own all those orange juices and
vitamin waters.
And,
There's a lot more they own than just that little red can.
Right. But that company pays you a 2.7% dividend, and PepsiCo pays you a 3% dividend, and they both have an illustrious history of dividend increases. Let's see, Kraft. Ever heard of Velveeta? Well, Velveeta cheese, snack foods, and things like that, that dividend is over 4. Now, isn't 4 pretty close to 5 on the positive integer number line, Chris?
Oh, see, you had me, and then you started using
I know, I'm just trying to do
bigger
that.
than 4-letter words.
Well, those are the words we say when the
is
microphone
4 close
is up.
to 5? Yes.
Yeah.
And just stop right there.
So if Kraft raises dividends, you probably don't have to, starting at 4.3, you probably don't have to wait so long before you're getting your 5% dividend already, and you don't have to deal with an insurance company. You're actually investing for yourself. Okay? Jeez, it's not that big of a stretch. Ever heard of Kleenex tissue? Well, that's Kimberly-Clark. They pay a dividend of 3.3. So why on earth, if you're going to have to give a commitment of 6 or 7 years, maybe 8 years, why not actually try to make some money? And I'm not even telling you that you shouldn't do the annuity, period. I'm just saying give it some thought. When you look at it with a very objective eye and with some logic, you might still want to do the annuity, but I bet you it'll be just a fraction of the money that you might be thinking of putting into it. And you may have not even have ever thought about owning individual companies before, but truly, how much risk would there be in owning a small portfolio of some of those names I mentioned? I think the odds of those companies going broke are slim. It's not zero. I mean, any company can go broke, but truly, don't you think that that the odds of them going broke would be pretty slim, Chris?
Little high to be all of a sudden everybody said, you know what, Coke didn't have a commercial for the Super Bowl, so I'm drinking Pepsi.
Exactly.
Or RC makes a comeback.
I know that there's risk and I know that there's volatility, but I don't think it's enough risk that it's going to kill you. And over 6 or 7 years, even if they have a bad year or two and the stock price dips, that there's plenty of time for the price to recover. So to me, I can't for the life of me see when folks make this huge commitment with tons of money to these annuities out there that really don't give them a whole heck of a lot. And then they have these not golden handcuffs, but just handcuffs where they have to pay a penalty to get out of the thing. And you've got hidden expense ratios inside annuities that are typically 2 to 3.5% and more. So just imagine deducting from your returns 3% per year. That gets to be pretty expensive. There you go. I mean, I could throw rocks at annuities all day long.
No, you touched a chord with me because it reminded me I had to pay a penalty once for getting out of some handcuffs, but I didn't know the safety word. So there were more fuzzy handcuffs. They weren't golden. That was another room.
You don't have to confess that stuff on the radio, Chris.
I'm an open book.
So anyway, yeah, I just don't. I think that when a person is investing, it's you have to be objective and you have to be realistic. And my whole industry is trying to tell you that volatility is the thing that you need to engineer out of your portfolio. And I hate to tell you, but volatility is the thing that will win the war. It's the thing that makes you money. It has good and bad points to it, just like most things in life. But if you understand how volatility affects you and you know 100% that it is going to happen to you, not that it might, that it will, then all of a sudden you start thinking, ooh, I don't want to put all my money there. Perfect. That's the way you should be thinking anyway. And if I'm going to take a risk, I sure as hell want paid for it. That's exactly the way that you should be thinking as well. So, yeah, there's a real true way to think about investing money, and then there's the ways where you think about maybe somebody selling you something. And I'm trying to highlight the differences. I'm Mike Wren. It's the show Smart Investing. You've been listening live on 590 KQNT AM. Telephone number to my office, 888-747-5181. It's the firm of Wren Investment Management, spelled W-R-E-N. We'll be back again next week, same place, same time.
Any opinions expressed herein are given in good faith and are subject to change without notice and are correct only on the stated date of issue. Past performance is not always indicative of future results. This material is not intended as an offer or solicitation for the purchase or sale of any security or other financial instrument. Security, financial instruments, or strategies mentioned may not be suitable for all investors. Prices, values, or income from any investment mentioned in this report may fall against the interest of the investor, and the investor may get back less than the amount invested. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation of particular securities, financial instruments, or strategies to you. Before acting on any recommendation on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.